In January 2026, Microsoft was the most powerful company in tech. Its stock sat near $550 a share. By July 20th, it had lost $1.1 trillion in value. That is not a typo. One company, $1.1 trillion gone. And if you have a 401k, some of that came out of your account. The reason involves a Chinese startup, a 25-year-old bubble, and $725 billion that big tech cannot stop spending. If you have a 401k, there is a very good chance you own Microsoft. Not because you picked it. You probably own a target date fund or an S&P 500 index fund, and Microsoft is one of the largest holdings in both. As of July 2026, Microsoft's market cap is about $2.99 trillion. That makes it roughly 4% of the entire S&P 500. If you have $100,000 in a standard index fund, about $4,000 of that is Microsoft stock. When Microsoft falls 21% in a year, your retirement account feels it. The same goes for Nvidia, Alphabet, Meta, and Amazon. Together, these 5 companies make up 20 to 25% of the S&P 500. When they all drop at once, your index fund goes down whether you like it or not. In late June 2026, the Magnificent Seven, those 5 plus Apple and Tesla, shed $2.2 trillion in value during a single rotation. The Financial Times reported it on June 30th. That is roughly $6,600 for every person in the United States, vaporized from retirement accounts, pension funds, and college savings plans in a matter of weeks. Apple overtook Nvidia as the world's most valuable company on July 17th. The Guardian called it evidence that investors are reassessing the outlook for artificial intelligence. Meanwhile, 61% of Americans told CNBC they are pessimistic about the economy, the highest reading since December 2023. Only 25% said they were optimistic. Consumer sentiment improved in July to 54.4, up nearly 10% from June, but still down 11.8% from a year ago. People feel worse off, and the stock market is telling them they are right to worry. The companies doing the losing are also the ones doing the spending. Microsoft has forecast $190 billion in capital expenditure for 2026. Meta raised its guidance to $125 to $145 billion. Alphabet sold $85 billion in new stock, its first equity raise in more than 2 decades. Oracle committed $70 billion to data center construction. Combined, big tech's AI spending totals roughly $725 billion this year, sending free cash flow, the money left over after expenses, to a decade low. The Financial Times put it bluntly: big tech no longer prints money, it needs it. Where's the money coming from? Partly from you. When Alphabet sells $85 billion in new shares, someone buys them. Often that someone is a mutual fund or an ETF, a basket of stocks you own through your retirement account, which means the money comes from ordinary investors' paychecks. Microsoft cut 4,800 jobs in its Xbox gaming unit on July 7th to redirect resources toward AI. The workers who lost those jobs are paying for the AI arms race with their livelihoods. To understand why the smartest companies in the world are pouring money into a hole, you have to go back to 1996. In 1996, the United States had roughly 200,000 miles of fiber optic cable buried underground. By 2001, it had more than 11 million miles. Telecom companies, drunk on the promise of the internet, spent roughly $1 trillion in 5 years laying glass strands across the country. The logic seemed airtight. Internet traffic was doubling every 100 days, and someone had to build the pipes. Companies like Global Crossing, WorldCom, Quest, and Level 3 raised tens of billions in debt and equity to lay fiber, build switching stations, and light up the network. The problem was that everyone had the same idea at the same time. By 2001, the market was oversupplied. Only about 5% of the fiber that had been laid was actually carrying traffic. The other 95% sat in the ground, dark and useless. The Financial Times later described the dynamic. A splurge of money can destroy shareholder value, but deliver consumer gains. Consumers got cheap broadband. Shareholders got wiped out. Global Crossing had a market cap of $40 billion at its peak. It filed for bankruptcy in January 2002, the fourth largest in US history at the time. WorldCom had a market cap of $180 billion. It filed in July 2002, the largest bankruptcy ever. Its CEO, Bernie Ebbers, went to prison for 25 years for accounting fraud. Quest Communications lost 95% of its value. Level 3 survived, barely, after its founder personally injected cash. The telecom sector shed more than 500,000 jobs. The Nasdaq Composite peaked at 5,048 on March 10, 2000. It fell 78% to 1,114 by October 9, 2002. It took 15 years to recover. The technology was real. The demand was real. But the investment was too much, too fast, by too many competitors, and the revenue could not keep up. The Financial Times published an article on July 6, 2026, arguing that the real difference between today's market boom and the late 1990s lies in capital expenditure. In the dot-com era, the overinvestment was in fiber optic cable. Today, it is in specialized computer chips, data centers, and power infrastructure. The scale is comparable. $1 trillion in telecom spending over 5 years then, versus $725 billion in big tech AI spending in a single year now, with Meta alone planning a $600 billion infrastructure push over the coming years. But there are differences, and they matter. The companies spending the money today are not debt-laden startups. Microsoft has $78 billion in cash on its balance sheet. Nvidia has $53 billion and a 63% profit margin. Alphabet has $127 billion. These are the most profitable companies in the history of capitalism. The demand side is different too. In 1999, Pets.com had no way to make money shipping dog food. Today, AI has actual paying customers. Nvidia's revenue was $253 billion on a trailing basis, with $160 billion in net income. So why can't they stop? Economists call it a prisoner's dilemma. If all of them stop spending, they all save money. But if one stops and the others keep going, the one who stopped falls behind and loses everything. So they all keep spending. If this is making sense to you, hit subscribe. It genuinely helps us reach more people with this kind of breakdown. Microsoft went first, investing $13 billion in OpenAI in 2019. By 2026, Azure was growing 40% year over year. Alphabet responded by selling $85 billion in new stock. Meta is exploring a $600 billion infrastructure push. Nobody knows if the revenue will come. That is the whole problem. The spending breakdown tells the story. Microsoft leads with $190 billion in forecast capital expenditure for 2026. Meta follows at about $135 billion, the midpoint of its $125 to $145 billion guidance. Alphabet raised $85 billion in new equity, including a $10 billion private placement to Berkshire Hathaway. Oracle committed $70 billion to data center construction. OpenAI, the startup at the center of the boom, spent $34 billion in 2025 alone. Combined, Big Tech's AI spending totals roughly $725 billion for the year. To put that in perspective, $725 billion is more than the entire economic output of Switzerland. It is roughly equivalent to the entire US defense budget. It is being spent in a single year by a handful of companies on a technology whose revenue model remains unproven at scale. The sell-off accelerated on July 17, 2026, when a Chinese startup called Moonshot AI unveiled a model called Kimi K3. The company claimed it performs on par with leading systems from OpenAI and Anthropic. The market reaction was immediate and brutal. The VanEck Semiconductor ETF, which tracks the largest chip companies, fell more than 4% that day. Applied Materials, Lam Research, Intel, KLA, and ARM Holdings each dropped about 4%. SK Hynix, which had just listed on the Nasdaq earlier in July, slid more than 13%. The fear was simple. If a Chinese startup can match the performance of models built on hundreds of billions of dollars of American infrastructure, Then what exactly did that infrastructure buy? And companies were already pulling back. Amazon, Walmart, and Uber introduced caps on AI usage. DoorDash, Siemens, and Airbnb started switching to cheaper Chinese alternatives. One source told the Financial Times, "We created a monster." The one-year returns tell a story of dispersion. Alphabet returned 90.2% over the past year. The Nasdaq gained 22.1%. The S&P 500 rose 18.2%. Nvidia returned 17.9%, far below the triple-digit gains it posted in 2023 and 2024. Then come the losers. Meta returned negative 8.3%. Microsoft returned negative 21.1%, the worst performer among the major tech names. This is the company that was supposed to be the AI winner. Microsoft peaked at $481.63 on January the 28th, 2026, then fell to a trough of $352.83 on June 25th, a 26.7% decline. It has since partially recovered to $402.29, but the chart shows a series of lower highs and lower lows. Each rally attempt has been met with selling. The semiconductor crash is even more pronounced. The SMH ETF posted its third weekly decline in 4 weeks ending July 17th, dropping almost 9% in that week alone. For the month of July, the SMH was down more than 17%. The Philadelphia Semiconductor Index was down nearly 19% from its all-time high. The sell-off was concentrated in the companies most exposed to AI infrastructure spending. The broader market held up better, but only barely. The S&P 500 fell 1.6% that week, the Nasdaq slid 2.9%, and the Dow dropped 0.9%. This was a sector-specific crash, not a broad market panic. At least not yet. South Korea's Kospi plunged 6.4% on July 16th, slipping into a bear market. The rout was spreading from semiconductors to software, from the United States to Asia. The physical reality of the AI boom is data centers. Huge buildings packed with servers, consuming electricity at a rate that strains the grid. A single large AI data center can consume as much power as a small city. The Financial Times reported that a century-old device, the electrical transformer, is choking the world's AI push. Oracle could face a $7 billion collateral bill for its Wisconsin data center. The companies building the most advanced AI in history cannot find enough electricians and pipe fitters to wire their buildings. In 2001, 95% of fiber optic cable sat dark. Today, nobody knows what percentage of AI compute capacity is actually being used, because the companies building it do not disclose utilization rates. The direct effects are visible in stock prices. The second-order effects are harder to see. Big tech is no longer financing AI spending purely from internal cash. Alphabet raised $85 billion in new equity. Meta is exploring Wall Street financing for a $600 billion push. Morgan Stanley has become the chief architect of data center financing. The Bank of England has flagged AI bonds as a systemic risk. When the most creditworthy companies in the world are also the biggest borrowers, they crowd out everyone else. The Bank for International Settlements, the central bank for central banks, warned on June 28th that AI exuberance risks a lengthy investment bust. Warren Buffett told CNBC on July 15th, "It's tough to find values when everybody is preferring gambling." Jamie Dimon said markets underestimate risks. Nobel laureate Simon Johnson said nobody needs as many white-collar workers as they used to. 3 scenarios. Scenario 1, the soft landing. AI revenue catches up to spending. Azure keeps growing 40% year over year. The semiconductor index recovers. This is the bull case, and it is not absurd. Scenario 2, the slow bleed. Revenue grows, but not fast enough. Chinese alternatives undercut pricing. Microsoft and Meta trade sideways for years. The AI trade becomes a drag on the market. This is probably the most likely outcome. Scenario 3, the hard crash. A major AI company fails. Debt markets seize up. The semiconductor index falls 40 to 50% from its peak. The S&P 500 drops more than 20% from its peak. Nobody predicted that in March 2000 either. 5 things to watch. Microsoft reports earnings on July 29th. If Azure growth is still 40% and capital expenditure is still rising, the bull case is intact. Nvidia reports on August 26th. Watch the SMH ETF. If it breaks below its July lows, the crash is deepening. Watch the Chinese AI models. If they keep matching US performance at lower cost, the big tech companies have a problem. If you are 30 years from retirement, stay the course. The market has recovered from every bubble in history. If you are 5 years out, consider your allocation to tech. Your money is funding this arms race. Whether you get it back depends on whether it produces a product people will pay for. This is not a technology story. It is a finance story. The technology works. The question is whether the companies building AI infrastructure can generate enough revenue to justify $725 billion a year. So I want to know, are we watching the dot-com bubble all over again, or is this time different? Drop your answer in the comments and subscribe for more.